So in this video, we're going to go over what the base rate actually is and why it's so important, why the offer for your mortgage rate is so much higher than this base rate, the 3 different types of mortgages you can get and the trap, what those mortgage rates will actually cost, and what that means for you now. And at the end, I'm going to give you the one best tip for when you're remortgaging. Let's get into it. So let's start at the source. So what is the base rate? So the base rate is the single most important interest rate in the country. So it's the rate that the commercial banks will use, and it's set by the Bank of England. So this is the Bank of England Monetary Policy Committee, as you can see on the screen. These 9 individuals, and they're the ones that make the decisions. So you would have seen that in April, they made the decision to hold the base rate at 3.75%. And I believe one of them actually voted to increase it to 4%, but it needs to be a majority vote. Now this base rate will steer all the products in the UK. So your mortgage rates, your other loan rates, your savings rates, all of those things are linked to this Bank of England base rate. Now the main aim of that committee is to decide whether the base rate needs to increase or decrease, and they usually base this around inflation. So their target for inflation at the moment is about 2%. So you can see here the target is usually 2% for the inflation rate. At the moment it's actually gone down to 2.8%, so we're heading in the right direction. So when prices are rising too fast, they'll usually keep the interest rate the same to try and slow this down. And when the economy needs a push, they usually cut it. So the next decision you can see here is due on the 18th of June. So because the inflation rate is still 2.8% and the target is 2%, and obviously with everything going on with the USA and Iran and energy prices, it's unlikely that it will reduce, but you never know what might happen in the next month or two. So now that we understand what the base rate is, why is your rate higher than the base rate? Surely it should be along the same lines. So from the past 3 months, the fixed rate rose from about 5% to about 5.81%. So where does this gap come from this rate to the Bank of England rate? So this actually depends on your mortgage type. So the trackers and the variables usually move alongside the base rate. But your fixed rates are actually based upon something else, which is called a swap rate. Now, without any jargon, swap rate is essentially them trying to predict what it might look like in the next few years, rather than what it is now. So that's why when you're locking in a 2-year fixed rate, the bank has to try and think about what actually is going to happen over the next 2 years and how can we incorporate all of that into one product. And of course, if you're then looking at a 5-year plan, it's even more complex. So that's why with everything that's happened in the past few months, the interest rates have risen so much, whilst the base rates have stayed the same. So obviously the economics behind that is very in-depth. But essentially, energy prices are rising, people are trying to predict inflation, nobody really knows what's happening with USA and Iran, boils down to interest rates for mortgages going up. So that's why when you're looking at your mortgage rate and you're wondering whether it's going to come down, you have to look at the whole picture, not just what the base rate is. So let's look at the 3 different types of mortgage products that you'll be offered. So first we have the fixed rate, which at the moment is about 5.81% for a 2-year and 5.7% for a 5-year. Now this changes very regularly. The tracker, which is about 4.75%. A tracker is the Bank of England base rate, plus usually about 1% a bank will offer you. So this means that if the Bank of England base rate was to drop to 3.5%, your mortgage rate would drop to 4.5%. But if the Bank of England base rate was to rise to 4%, your mortgage product would then raise to 5%. And now the third one is the one that we want to avoid at all costs. This is the trap. If you're looking to remortgage and you don't make a decision, you'll automatically default to this SVR, the standard variable rate. And this is usually around 7%. Now, if you don't make a decision and you end up on the 7% rate, that can cost you hundreds. And we're going to go over some of the numbers in a bit, but you really do not want to be entering this. Now, remember the 2-year and the 5-year fix are pretty much the same at the moment. So really it depends on your individual situation. And it's less about the cost, but it's more about, do you think rates are going to fall in the next 2 years? And do you see yourself keeping your apartment or your house for the next 2 or 5 years? So drop a comment on the video as to what product you're on or what product you're thinking about. I'm very interested to know. So let's look at our mortgage cost calculator that I built. And this will just tell us what the difference is between all these different rates. Now we've put in here our 2-year fixed, our 5-year fixed, our tracker base, and our best low, and our best deal, which is a low loan to value. We're probably going to focus on these 3 blue ones here because they're the most comparable for most people. And at the moment, the Bank of England base rate is 3.75, so our tracker base plus 1 is 4.75, and obviously the 2-year and 5-year fixed is much higher. So let's assume here we can just move this toggle. Now, if you want this calculator here, I'll put the link in the description. It's very useful for just visually seeing how much things are going to cost. If you move the loan amount here and the amount of years that you've got your mortgage term for, you'll see this amount here changes, and this will tell you how much it costs you if you just remain on this standard variable rate. And you can change your old rate and your new rate here to see how much extra you're going to be paying when your mortgage deal expires. So let's assume we've got a house for £300,000, or we want to borrow £300,000. And these are our 3 rates here in blue. And let's say we change our term here. Let's say we're thinking about whether we should take a 20-year term. So you see at the moment, they're very similar. Now see at the moment, the 5-year fix and the 2-year fix, there's almost nothing in them. But the tracker base is slightly cheaper here at almost £100 from the 2-year fixed. Now let's say actually we're thinking about a 30-year term. You keep moving these sliders, you can see how this kind of changes. And here you'll see it's actually £200 cheaper to be on a tracker. And we can move our loan amount and you'll see the amounts moved there. But as before we mentioned, we really want to point out here, leaving your loan to default into the standard variable rate is going to be very, very costly on a month-to-month basis. Now, if you're predicting that something drastic is going to happen in the next month, or you think actually for specific circumstances you need to wait 1 month, this is just a one-off cost. So as long as you're making the best decision for yourself overall for the term of the mortgage, which could be 5 years, this is actually quite minimal. But we do want to try and avoid this. And as we see here, the more our loan will be, the more this is going to cost us. Now, there's one thing that I hear a lot of people scared about is old deals expiring. Now, I see a lot of people who are still on the 2 or 3%, maybe from the COVID days, and they're up for remortgaging soon, and they can't believe how high the interest rates have gone. And this little tool here at the bottom will tell you how much your interest rate is going to change. So if we say we have a £50,000 mortgage, and we were looking at a 25-year deal, and we were on, say, a 2.4% rate, and we're getting offered a 5.7% rate. This is going to cost us £456 extra per month, and it's a huge deal and it's a huge change. But this little tool here at the bottom will help you figure that part out. Now, a lot of people will be thinking, well, why don't I just stick to the tracker because it's the lowest one? The tracker looks great at the moment because it's the lowest one. Now, remember, the Bank of England meets very regularly and they make that decision every few months. So you'd have to always be thinking about, well, are they going to raise it? Are they going to cut it? And that's an immediate cost. As soon as they change the base rate, your mortgage will go either up or down. And this is just another image to show you the difference between the three products. Now, if you have a low loan to value, you might be able to get a much better rate at 4.4%, and that's really the best you can probably do. Now, if we look at a 2-year rate, which is about 5.81% at the moment, depending on your loan amount, this is how much it probably would cost you per month. So what does this mean for you now, and what can you do about it? So the very first one, this is the most important thing that I spoke about at the start of the video, the number one tip. If your rate is expiring in the next 6 months, call up your bank and get a quote. Now, double check, but most banks will let you lock in that rate. And if the rate falls within the next 6 months, you can keep updating that rate to the lowest one. So for instance, if you were due to renew this summer of 2026, if you had locked in a rate in January 2026, you'd be much better off than if you were remortgaging this month. So just start now, call your bank, get a rate, fix it in, and you can always change it if the rate goes down. Now, the biggest decision you're going to make is, should you be on a fixed or should you be on a tracker? Now, of course, the tracker is lower at the moment, but you never know when the Bank of England is going to raise them. And with the fix, you can budget your money for the next 2 or 5 years and you know exactly how much your mortgage is going to cost. Do you have much knowledge of the market? Do you have much knowledge of what's going on? And do you really think that the rates are going to come down? And again, as we spoke about before, the Bank of England base rate gives you a bit of a clue as to what's going on, but it really is not the rate that you're being offered. The rate that you're being offered is based on a lot more of the macroeconomics of what's happening around the world. So now you know why there's a big gap between the mortgage. You have to then make a decision. So hopefully this has helped you understand what's going on. Hopefully now you can make a better informed decision. If you do want any of the trackers or the spreadsheets, I'll put them in the description below. Let me know if you have any questions and we can start a discussion in the comments. Please consider subscribing so that I can make more helpful videos in the future.